Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes, but when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Good evening and welcome to our FOF session. 2 dates for the forthcoming FOFs, so you can mark your calendars. December 5th, which is quite close. Reason for keeping it early part of December is usually people have travel plans later part of the month. So December 5th is the first one after today's session, and the next one will be on January 16, 2019, Jan 16. December 5, Jan 16. Let's jump into the presentation for today. It's titled The Road to Zero, Dha. So story so far, we all have been reading the financial press about more money coming into the stock market, into mutual funds. We have read about EPFO starting to invest in equities. Gold hasn't delivered too much of return. People's money is stuck in real estate projects. They are not happy with real estate the way it is. Rental yields on residential properties are 2.5%. You have to pay maintenance. You have to periodically take care of the upkeep in terms of getting it painted or whatever. Sometimes projects are delayed. So traditional avenues are not that attractive. Small saving rates have come down over the years. There is talk that how Indians will become affluent in the coming years and decades, and when people's incomes go up, their basic expenditure does not go up in proportion, so disposable income goes up, which results in some increase in savings and investment, some increase in discretionary spend. So all these factors are there. So what's there not to like about this? And clearly, if this is the way the story has played out in the last few years, and this is what we expect in the next decade or two, the financial stocks should do well. We have discussed asset management per se as a business activity. Today we are taking a slightly broader view. We are looking at capital market related companies and businesses. So this is, I've just taken a few random names. This is Edelweiss. I've taken 10-year returns for all of these. So annualized return has been close to 20% total return, including dividends. Motilal Oswal Financial Services, annual returns have been about 28%. Not bad, right? IIFL close to 30% again. GeoGeeth hasn't been that high, but again close to 10%, not too bad either. So this is the story so far, and what's there not to like? People would assume that this is the way the story will play out in the future. Maybe it will, but I'll today just highlight some of the trends that are there which potentially could cause discontinuity, and there is also a remedy available. So we'll look at both aspects: what is the discontinuity and what is the remedy, and how to evaluate these kind of companies and businesses when we are investing, or if we are in this profession, how to look at the evaluating these changes which are happening. So before diving into it, just to keep in context, obvious prospects for physical growth do not translate into obvious profits for investors. We have learned this the hard way in sectors like telecom. We have learned this the hard way in sectors like aviation, where there has been tremendous amount of volume growth, but profits for investors have not been that great. We have learned this the hard way in a sector like retailing, with the exception of maybe a DMart. A lot of companies showed a lot of promise, but investor returns were not that great for investors. So what matters in investing is not just prospects for physical growth. What also matters is the pricing and margin environment, the competitive intensity. Those are the kind of things one has to look at, rather than just say that financialization is happening or volume growth will happen. So an interesting book which came out in 2018, and for those who are closely linked with the market, I would urge you to read it. It's a book by Howard Marks, Mastering the Market Cycle, and he links the market cycles to something like a pendulum, where a pendulum on a clock or any pendulum swings between extremes of extreme optimism and extreme pessimism. So here, if we look at the central line as fair value, it may act as gravity. It may attract stock prices, but stock prices spend very little time at fair value. They will, most of the times they will be either undervalued or overvalued. So they tend towards fair value, but not necessary that they should spend time in fair value zone. So when we are looking at capital market related businesses, and we have seen past returns looking quite good, one should realize that there is a cyclical element to any stock market related business. So a lot of people look at sectors like, for example, metals as cyclicals, saying they go through a boom cycle and a bust cycle. In a way, capital market related businesses are also cyclical. 10 years seems too far back, but between 2007 and 2008, where the indices fell by half, effectively, even if there were no outflows for mutual funds, their AUMs, equity AUMs would have fallen by half in that 1 year period. Brokerage activity is high when markets are at high levels, because everyone is sitting on profits. When people are sitting on profits, they want to sell what they have, buy something else. If people are sitting on losses, they just keep nursing their wounds. They neither buy nor sell, they just go into a shell. So brokerage goes down, fresh flows come down. So when we saw that things have not been that good for traditional savings, that was true up to 2017. 2018 actually, things have started turning a bit. We have seen interest rates going up. We have seen equities not doing that well. Balanced funds which were sold as alternatives to bank deposits, those are showing capital losses. So there could be cyclical elements which would play against the capital market related businesses over the entire industry. But that's not what today's presentation is about. We will stop here on the cyclical part. I am more talking about the structural part. Even if you say I have 10-year view, 20-year view, it doesn't matter what year-to-year fluctuations in capital market related businesses are there. If you say I want to own, let's say, a IIFL, Edelweiss, Motilal Oswal, a basket of capital market related businesses for next 20 years. Even then, there are some trends that you should keep in mind, and there is a way I would think makes sense in terms of evaluating these businesses. Before getting into the framework for evaluating the businesses, let's look at what do these kind of companies offer. What does a capital market intermediary offer to the clients? Their value proposition is, one, they offer trade execution. This is a picture of the BSE ring where there was an open outcry system and people would gesture and people would stand in particular locations depending on which stock you wanted to buy or sell. This is how the trade execution used to happen, and this was pretty much the only service that was offered maybe 3 decades back. Brokers did not need to offer research reports. They would not offer an online portal or anything else. You had to queue up outside a broker's office, plead with them to either buy or sell shares for you, and they would reluctantly, as if they are doing a great favor to you, agree to do your trade. And for that privilege, you had to pay a 2% brokerage fee and an undisclosed amount of spread over the execution price. So actual brokerage would be anywhere up to 3, 4, 5%. That is one value proposition, trade execution. As time went by, research. So people tell you what to buy and what to sell, when to buy, when to sell, what will be the price that will be there in the future, as if they know, but they tell you what is the future price that will be with decimal point precision and even the date. So equity research is a value proposition. Also, they sit across the table from you and advise you how much to put in liquid funds, how much to put in debt funds, how much to put in equity funds, which funds to select, what kind of insurance to buy, how to save taxes, all of that. And they have, most of the financial conglomerates have asset management companies where either they run a hedge fund called AIF, or they have a mutual fund license or a portfolio management service, or they will offer structured products, real estate related products, venture capital, private equity, angel funding, all those things. So given my deep liking for Bollywood, let's take a look at a Bollywood clip since the talk has become quite boring.
इसके पहले कि तुम्हें हम और बर्बाद करें, यह हवेली छोड़ दो देव, छोड़ दो।
बाबूजी ने कहा गांव छोड़ दो, सबने कहा पारो को छोड़ दो, पारो ने कहा शराब छोड़ दो, आज तुमने कह दिया हवेली छोड़ दो। एक दिन आएगा जब वो कहेगा दुनिया ही छोड़ दो।
So the fear that I have, or a lot of people have today, is that something similar is happening to the financial services industry. Zerodha ने कहा brokerage छोड़ दो, Paytm Money ने कहा distributor commission छोड़ दो, index fund ने कहा asset management fee छोड़ दो. एक दिन ऐसा आएगा कहोगे financial services ही छोड़ दो. Okay, I'll take a minute when people are clicking the slide photo. Although it will be on the recording, will be on the web. You can click a picture if you want. So these people have already come by. It's not in theory, it's not something which will come down the line. Okay. So this is just in just to lighten things up, and let's look at the way forward. But the question is, are we at a make my trip moment for the industry? Just like you had people booking airline tickets or hotels for you, travel agents, and you had to pay them a fee to book a ticket for you, and actually those long paper tickets would come with multiple sheets inside them. Now people do it on the desktop computer or on a mobile app, and a lot of people got disintermediated. Are we in such a moment for financial services? If yes, what are the implications? If no, why not? How to look at these businesses? Where is the, and it's not that the revenue that travel industry gets has gone away. It's just that whenever a discontinuity happens, there is a shift. Value goes from one party to some other party or in some other form. So where is that value is what we will see down the road. And before we jump into this, even today I'm sure there are some people who are not tech savvy and who still go to a travel agent to book a ticket, or there will always be pushy relatives who will emotionally blackmail you to buy some high commission policy or some product. So preying on ill-informed people will always remain a business model. We are not talking about that. We are talking about the general customer. So one model which will emerge in my view, and it's preliminary, is there will be some people who will go all out saying, let me compete on price, let me automate a lot of things, let me standardize the whole process. The value proposition becomes so good for the customer that the customer will not go anywhere else. So I'll come back to this slide. Let's look at, let's say, zero-dha pricing, which says I'll not charge anything for equity delivery based trades, and I'll charge 20 rupees for intraday futures and options transactions. And you have a nice mobile app, or you have a website, and you can also download a trading software kind of thing, or you can have APIs which link to the thing. So here they are going for scale and automation and very low pricing. So again, you have a variety of players, 5paisa.com or Samco, and there are at least 7, 8, 10 brokers who are there competing on this space. Or just like you have Go IBBO and Yatra and Make My Trip and all of these, you will have some people who take the automation route, and they will obviously be successful. Their per transaction revenue will be very low, but their volumes will be so high that they will be profitable someday, hopefully. So that is one model that could be there in the future. The second model will be premium players, niche players. So even today, if someone wants a very personalized service and someone does not want to sift through different portals and keep track of prices going up or down, or figure out whether they are connecting flights, not connecting flights, or do the whole itinerary, including hotels, stops, and plan out things for you, people may want to pick up a phone and talk to a travel agent, say this is a complex itinerary and I'm going for my, let's say, 25th wedding anniversary, or I'm going for my honeymoon, or we are going as a group and do all the planning end to end. I don't want to do it piecemeal. So there would be players who will give full manual service. It will not be an automated thing. It will not be a standardized thing. A lot of customization is required. And there would be players who would be offering this. So there's a mistake. It's not high volume for the service provider. Some of the large customers would be taking this kind of a service, and their business model will be, margins will be higher, but volume will be lower, and multiplication wise, they would be decently served. So equivalent of this would be, let's say, all the wealth management firms, all the multinational banks or Swiss bank subsidiaries in India, or all the everyone who says private wealth, private banking, private client group, all these people. So that would be the second model, and it will not go away because all these mobile apps have come about. The third thing is that while pricing will be one of the very key determinants in trade execution, it may not be that big a differentiator in the asset management space. It will have an impact, but not that big. I'll tell you why. Typically, when people choose a doctor, they don't necessarily choose the lowest priced doctor. There is some amount of comfort with some doctor, or whether real or perceived competence or experience, seniority, those things play a role. Now, if you have to get a heart surgery done, you will not put out a tender in the paper saying the lowest bidder gets my business. You want to go to the best person. Whereas if you are, again, that's for heart surgery. If you have a cold, maybe any general practitioner who's a qualified MBBS would do. It may not be that critical. So somewhere maybe pricing would come into play. So look at it, heart surgeon, general practitioners, and chemist. Chemist, as long as it's the same brand name, unexpired medicine, you would go to the lowest cost provider. So one is extremely commoditized, one is extremely niche where quality matters, and there is somewhere in between. So if an asset manager is clearly able to position saying we have better capability, they may be able to charge a better price. Or sometimes there is access issue. So while in a large cap equity fund, index funds will definitely be competitors, and there would be a downward pressure on pricing and the fee that asset management companies can charge. If there's something like a asset reconstruction company or a stressed asset fund where it depends on turning around companies or intervention, now that is not amenable to something like an index fund. If there's a venture capital fund or there's an angel investing fund, now those are specialized services. You cannot have price competition in that, and that will probably remain as a niche business and as a activity where it's somewhat immune to price competition. Investment banking, which is the act of raising funds for new companies or advising people on mergers and acquisitions, again competence and quality would play a role. Some of the standardized players, let's say these discount brokers, they will offer brokerage at a very low cost or close to zero. But if you, let's say, want to have loan against shares, now that's where they can effectively price their product at a slight premium and start making profits over there. So lending money and fund-based activities could be a profit center. So going back to the thing, see, when the pricing is so low, there is possibility of them using the free pricing as a hook to get the customer in, and when the customer is already in, then they would want to cross-sell some of the high margin products. So in Diwali, in all these great shopping festival and all that, the ads that you see in the papers, they will mention 3 or 4 very popular items of mass consumption, and they will offer such low prices that you are attracted to go to the, let's say, go to one of the malls or one of the e-commerce sites and start shopping. But those will be the loss leaders, what is called a loss leader in an industry. That product gets the customer in the store or on the website. The real profit is made on other products which are not marked down to that extent or which are earning a high margin. So that's one of the possibilities that will happen where, and we have seen this in the case of wealth managers, they will offer very low rates for, or they may be offering direct plans of mutual funds, they may be offering close to zero brokerage and all that. But once in a while they'll slip in, buy these unlisted shares of Ola. Now, no one knows what is the actual value of those shares. No one knows how much commission they are getting. Or once in a while they'll slip in this structured product, buy this Nifty linked debenture, or buy these shares of National Stock Exchange, which is unlisted but looks very attractive. Now, they may be good deals, but to the intermediary, they may be offering brokerage rates akin to those open outcry days, 3%, 5%. So whatever you have given away in terms of brokerage on delivery transactions on BSE, NSE, that you may make up on unlisted shares. So that's a issue. Again, in all app-based systems, there's always this risk of your customer data being used. They know your income levels, they have your contact details, and they may start pushing other products. So we have seen this third model, non-standardized stuff. Model 4 is some combination of effectively 1 and 2, where you are using scale, you are using computer technology, automation, scale advantages to do most of the work, but at the same time you also have human customer interface. The pricing is not premium pricing, it's not the discount brokerage pricing, it's somewhere in between. So this is something like a hybrid pricing. So let's say ICICI Securities, it's not just automation, they also have a mobile app and a website, but they will also offer phone-based support, they'll offer research, they'll have human advisors. So same with something like a HDFC Securities. So in model 4, we could see a combination of humans and machines rather than taking a either or approach. So in segmentation, this would appeal to affluent and mass affluent, so mid-income people or even affluent people. Model 2 is only for affluent, and model 1 is standardized and really the masses. So there would be segmentation of the customer base going forward. And this is the interesting part. This is something which has taken the developed world by storm. We are seeing initial signs in India as well. This is essentially using technology to offer personalized and customized solutions. Some element of human involvement, but it's doing complicated work that earlier humans would do, and using that to provide tech-based services. So I'll just give one example. Let's say something like a Artha Yantra. Earlier, people thought that financial advice or customized advice can be only given by humans. What these people have done is, like for a Gmail or Make My Trip, you first you sign up and you create your ID. And later on, they depend on you to provide all the data. You to provide your income, expenditure, assets, liabilities, family members, details, your goals. You answer all the questionnaire. where it does the risk assessment, and then they give you a financial plan, they execute it for you or enable you to execute, and then manage it ongoing. And again, these kind of models are using the same freemium kind of thing that other tech companies do. Freemium is combination of free and premium. So they will offer a version which is free, and they will also have some paid plans. Like you see here, the basic stuff is free for you, and then if you pay 1,000 rupees a year, you get these things, and if you pay 6,000 a year, you get all these things. So it's a graded model, and as they hook you in, periodically they'll nudge you to sign up to the higher amount. Yeah, so this is the bulk of the presentation. What do I think will actually happen going forward? I think finally it's not as easy as booking a air ticket. In a air ticket, you clearly know that you want to go from place A to place B. You typically know the mode of transport, whether you want to travel by air, bus, or train. You generally know how much you are willing to pay for the trip, and you go ahead and book stuff. We were just, Ronak and I was just chatting today and trying to get an analogy for this. Offering a direct execution platform without the customer knowing what is to be done is akin to letting people buy medicines without any prescription or without having any idea. Now, some people may be qualified to do that. Not everyone may be capable of doing that. So either of two things can happen. One thing that could happen is people will stick to the existing system, and these things may not take off in a big way. The other possibility is people may jump into it, burn their hands probably by buying buying the wrong product at the wrong time or something like that, and then get put off by market related instruments and not come back to the market. Say, this is not for us. We will stick to our small savings and bank fixed deposits and gold. And the third possibility is that the industry responds in a very proactive way. What would that be? One thing is clear, that as volume grows, both the regulator and the customers expect from us as an industry, whether it's us as brokers, whether it's us as asset managers or distributors, they expect from us transparent pricing. They expect to get some volume benefits. So if you were getting a 2% commission on 1 lakh volume, now if volumes have gone up to 5 lakhs, you can't still ask for a 2% because the amount is clearly shown to them, either on your contract note or in the cash that is there, how much you are charging them. That is clearly known to them. So they need to see value addition coming in from the industry. So what the industry needs to do is use technology to drive down their own cost. Once costs have been driven down, pass on part of the benefit in terms of more attractive pricing and clearly indicate to the customer that this is the value we are providing, either on the brokerage side or distribution side or the asset management side. If anyone is stuck today in the 1980s mode, where for going into the ring and executing a transaction, or for filling a form and getting a check, we want to be paid a princely sum, then that person will have it very, very difficult in the coming days. But if someone is more like a trusted doctor, then that person would be able to still command a price. So I am saying, if execution is your only offering, if you offer nothing else to the client, if all the client gets is a demat slip filling or issuing of a contract note or collection of a check or collection of a form, then that service is toast. Like travel agents went away, the intermediaries would go away even here. If it is differentiated and if you follow one of those 5 business models and you clearly know who your customer is, whether you are competing on price or you are competing on differentiation, then that possibility is there. Volume growth may be huge. So just as a statistic, if you add all the demat account numbers between NSDL and CDSL, my guess is it would be somewhere about 2 crores. Again, unique number of PAN holders in the mutual fund industry are less than 2 crores, about 1.85 crores. So the base is very, very low of people in the capital markets. The growth will be huge on this volume. At the same time, it will be a reality that pricing pressure will be relentless. As growth comes in, pricing will have to come down and we will have to be geared to lower pricing, and a combination of the two at the net level, revenues to the industry would probably be growing at least for a while. People who are geared to do this will benefit. People who are not geared could become irrelevant. So I think whenever we are evaluating the prospects of the companies where we are investing, this would be a very important factor. Let's say you are evaluating Geojit BNP or Geojit Securities, or you are evaluating MK or ICICI Direct or Edelweiss or Motilal Oswal or IIFL. Now, whenever you read their annual report or the conference call, if these mental models are there, you can clearly say these people are following this strategy. Sometimes the same organization may be following different strategies for different product segments, and which is a smart move. For example, 5paise.com is owned by IIFL. They operate even in the private wealth management addressing HNIs, as well as they are operating in the completely tech-driven, price-driven competition kind of mode. So these would be useful frameworks to keep in mind. So that's the talk for today. Happy to take questions that you have.
So broadly, as a percentage in America, how would the assets be divided between equity mutual funds, index mutual funds, and private equities held in clients' demat?
I don't have the number offhand, but last 5 to 7 years, the shift has been very, very rapid towards passive investing, which is index funds and ETFs. Especially ETFs have been getting a big share. Just for context, in India, ETF prices have become really very competitive. Bharat 22 ETF, which is run by Prudential ICICI, has a expense ratio of 0 to 1 basis point, I think about 1 basis point of late. Some of these Nifty linked ETFs where they are getting EPFO money, those are at 5 basis point expense ratio. Among the most expensive index linked ETFs, Nifty linked ETFs are at 10 basis. So that's the range. This is passive investing. Active investing, most funds, even in direct plans, have expense ratios in equity north of 1%, and regular plans would be close to 2%. Now, 5 paise versus 2 rupees as a difference in expense ratio is huge. Now, for the actively managed fund, if you are going to do intense research, manage a reasonable sized fund which has flexibility, and despite the expense, if you are able to give higher returns, people will come to the active fund. But in an active fund, if it's tens of thousands of crores in size, and if you are going to buy the same TCS, Reliance, HDFC Bank in roughly the same proportion as index, then clearly your returns will lag that of the index, and over a period of time, people will start shifting their volume. In India, asset management companies have been getting valuations of whatever 6% of AUM, 7%, sometimes going up to 8-9%. Globally, these are very, very high numbers. They are actually 2%, 3% kind of numbers. In fact, recent media stories, I don't know whether it's true or not, but IDFC was being quoted at somewhere about 3% of AUM, IDFC mutual fund. Globally now, I think passive investing has crossed 50%, if I am not mistaken, in the developed countries. So that is a real threat. So ironically, in the discourse, a lot of the times people keep fighting among themselves. So mutual funds say distributor should bear the burden, distributor will say mutual fund should bear the burden, whereas the client is saying, I don't need any of you, I don't need the mutual fund house, I don't need the distributor, and I don't need the stockbroker. I'll go and buy a passive fund and I'll run it at 5 basis points. So really the question is not about entity A or entity B. Really the question is about what differentiation you are offering to the client, what value proposition you are offering to the client, and as you are getting volume benefits, are you passing on the cost advantages to the client or not? If that is true, I still believe there's room for everyone, for human advisors, for human asset managers, for human stockbrokers. But we will need to, just like from a handloom era to textile mill era, where there was a change in technology, the financial services industry is undergoing that technology. So one has to adopt more and more computing in the activity that we do, and we have to offer a good value proposition. Anything else?
Yeah, in wealth management, clients will always need the services of the RM because they may be experts. Yeah, they may be experts in their own area of business. But from experience, I have seen many of the high net worth individuals or ultra high net worth, they can't even read their wealth management statements. Like recently, the bond yields moved up and the prices came down. They were wondering why their portfolio has been affected so much. So I personally feel like when it comes to high net worth or ultra high net worth individuals, they will always need the services of some professional to hold their hands, especially in these turbulent times, you know. And this area of wealth management is growing, like all the firms are planning to recruit, like recently there was an article that they are planning to recruit X number of wealth managers, not only in India but all over the place.
Correct, sir. Absolutely agree. So that's the model 2 I spoke about. The affluent people will continue to be serviced by human relationship managers, and if someone, typically the cutoffs are somewhere about $1 million for assets under management, and people put in all the human efforts. They are of course at the back end serviced by computing technology, but for the client it's a human interface. The client is not required to use too much of computing to get serviced. So I gave an example, let's say Julius Baer for example, or IIFL Wealth Management. Again, IIFL has a wealth management arm which employs human relationship managers for the affluent people. At the other end of the spectrum, they run a completely automated thing. What will happen is that clients, being the way clients are, and not only in India, world over, or in any sector, not just in financial services. If I am a client for a retail product, I want lower prices, I want more variety, I want faster delivery. As Jeff Bezos says, clients are ever demanding. Today, when something is available to you at a much lower cost, and where the media will keep pounding that exchange traded fund is at 5 basis point expense to the client, whereas a regular plan of a mutual fund, actively managed mutual fund, if it is 2% per annum, the wealth manager may be very nice. They may be wishing you on your birthday, anniversary, sending a Diwali gift, a Christmas gift, advising you on what happens to the global economy, what will be the political result, all of that. But finally, when the report comes to you, let us say if someone has 10 crores of investments and if the wealth manager has earned a fee of 20 lakhs in a year versus close to negligible on a automated platform, and where the returns on the funds that are selected to you handpicked by a wealth manager, if those are showing a return lower than Nifty or Sensex, then obviously there will be a huge pressure. I am not saying they will be irrelevant. I am saying two things. One is they will be only be able or firms will only be able to afford human relationship managers for a certain cutoff, for mass affluent or affluent. You cannot employ human relationship managers for low ticket clients. That is one. Secondly, even for these customers, as volume grows, pricing pressure is or pricing trends are downwards. In 80s, people were happy to pay 2%, 3%, 4% brokerages for equity shares. Today, when a automated platform is offering free delivery, even if you choose to deal with a human broker, you will say maximum I'll pay you 20 basis points. That pricing trend is downwards. So as I said, I'm just kidding. It's not that I expect everyone to be irrelevant. It's just that rapid change is coming, and when one is giving a valuation to a particular company or when one is projecting revenue and profits, the volume growth will be faster than the revenue growth because pricing will be downward. I completely take your point. It's a complex subject. Not everyone will be comfortable with just dealing with a computer screen or a mobile screen app. People, or a lot of people, will need human interface. Also, partly it may be a question of probably the generation in which we are. Let's say my daughter, from the time she's been born, she's seen internet and she's seen mobile apps. So those people will be more comfortable probably dealing with apps and technology. Probably I am somewhere in the in-between generation. I've seen only human world where banks maintained manual ledgers to smartphones, whereas some people may want a human interface all the time. So it will depend on personal preferences. The pricing pressure will be down.
As an industry veteran, if somebody is setting up a shop today, what is your advice to that person?
If you are setting up a shop today with your team or who are the founding people, get into a room and say, out of these 5, which is your choice? At least select one, conquer that one, and then if you want, go to another one. Are you a fintech player where you will sit in a room and create the next WhatsApp or whatever, where one app which will become so popular that it will give you a scalable business where you will get a lot of revenue? Is that your model? Or are you trying to service the ultra rich people of the country? You will just service 3 wealthy families, charge them a transparent fee, add value to them? Is it that? Or are you going to do differentiated asset management, say like you'll advise people on distressed debt, or you have expertise in early stage companies and you'll advise people on startup company investing? So what is the area where you are choosing to compete? If you are starting off as a generic player saying, I will give you a list of funds to invest in, I will fill the form for you, I'll take the check from you, I'll take your PAN card copy, I'll take your Aadhaar copy, I'll do KYC for you, then I would advise not to start the business. That would be my advice. Because there are too many standardized players and that is vulnerable to the trends that I mentioned. Great, thank you so much. Look forward to seeing you next time.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.